Hello and welcome to Quarterly Perspectives, fourth quarter 2022. My name is Broderick Mullins and I am the portfolio manager here at Covenant Wealth Advisors. I'll be your host for this presentation. This presentation details quarterly equity and fixed income performance along the framework of absolute returns, relative returns, and future expectations for market performance. We will then go on to discuss recent interest rate movements and inflation expectations. Last, we will examine how different asset classes contributed to an overall portfolio return. We hope you enjoy today's presentation. Now let's get started. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from the illustrations, U.S., developed international, and emerging market stocks were up during the fourth quarter, reversing the negative trend from the prior quarter. Quarterly returns for U.S. and global bonds were also positive. While markets made a strong rebound in Q4, performance for the full year in 2022 remains negative. Next, I'll draw your attention to the upper right-hand portion of the graphic. The US dollar was down 7.7% for the quarter, but is still up 8.2% over the last 12 months. Now let's look a little deeper at what was driving the returns of stocks and bonds. We'll start by taking a look at how global equities performed for the quarter, and we'll isolate the performance between US and developed international stocks. The two charts show the performance of different investment styles between the US and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. US returns are measured with the Russell indexes, and international market returns are measured with the MSCI World ex-US Index Series, which represents global developed market performance, excluding the US. As we can see from the dark blue line on the chart on the left, the US market was up 7.2% in the fourth quarter, compared to up 16% for developed international markets on the chart on the right. Value stocks outperformed growth stocks in both US and international markets. Large value stocks had the best return in both US and international markets. Large growth stocks in the US market continued to struggle, bucking the trend of the last few years. But no matter the recent trends, it's important to remember that we shouldn't make longer-term projections based on short-term performance. Now we take a longer view to see how different investment styles have performed for standard periods ending December 31, 2022. Looking at annualized returns in the US, we can see it has been a challenging time in all areas of the market, particularly for growth-oriented stocks for the one-year period, as the recent performance has faced significant headwinds, such as ongoing fears of a global recession, continued geopolitical uncertainty, and rising interest rates to help bring down inflation. All of which together has manifested itself in heightened economic uncertainty and market volatility. Large value stocks had the smallest decline for the trailing one-year period, losing 7.5%, but beat the US market by 11.7%. We can also see that small and value stocks have generally been out of favor over the 3, 5, and 10-year periods. Consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. Keep in mind that the very long-term evidence demonstrates that on average, small stocks outperform large stocks and value stocks outperform growth stocks, but size and value factors can still go through extended periods of underperformance like those shown above. Turning to international markets, we see that large cap value stocks have led the pack over the 1-year period. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering the highest returns over the 10-year period at 5.8% and 6.0%, respectively. Relating the prior slides, we see that international markets have underperformed the US market at time horizons longer than 1 year, with the 3-year performance trailing by 6% per year and the 5 and 10-year performance trailing by 7.2 and 7.4% per year, respectively. Given the higher US return, we expect portfolios concentrated in US stocks to have outperformed a globally diversified portfolio. However, as we'll see in the next slide, these relative performance numbers are not reason enough to abandon international stocks. Thus far, we've discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market valuations and how they relate to future expectations of market performance. The charts on this slide show how expensive stocks are by measure of the price to earnings ratio, a very common metric used to value equities. The higher the ratio is, the more expensive the asset class is overall. Thought of another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total US stock market costs roughly $18. Internationally, as we can see in the chart on the top right, earnings are cheaper at less than $13 per dollar of earnings on average. The values represented here use historical fund and ETF data to establish the price ratios, and the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for US measures and in the fourth quarter of 2006 for international stocks. After significant declines in 2022, the US market is in line with, and international markets have dipped below their recent historical averages. We can also see that small value stocks in US and international markets appear cheap relative to their recent historical average. All else equal, we would like to pay less for a dollar of earnings. These valuation ratios aid in setting expectations about the future. Low valuations imply higher future returns and vice versa. The recent market declines mean that it is reasonable to expect higher returns than in the recent past, when valuations were above their long-term historical averages. I'll emphasize that this is a long-term relationship, and in the short term, the outcomes will be dominated by the unexpected forces like interest rate changes, war, and inflation, as we have seen in the past year. Here we have the same analysis, but isolating US equities, so we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings, as the PE ratio has climbed to 26.1 to close the quarter, which, even after the challenging performance of the last 12 months, is above its average since 2004. Small value, on the other hand, even with the rebound of value stocks relative to growth stocks during the last 2 years, still has a PE ratio under 10 and under its average since 2004. Although many investors may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we'll take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing inflation. The charts on the screen show the average performance of different bond maturities and the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left side, we see that bonds of all maturity ranges had positive performance, but markets favored intermediate maturities relative to shorter and longer term maturities. The chart on the right shows the performance of different intermediate maturity credit quality bonds. We see again that all bonds in the credit qualities listed were up for the quarter, with investors favoring municipal debt relative to other government and corporate debt. Next, we'll look at the Treasury yield curve and what it means for returns going forward. Here we plot the yield curve to show the current yields for Treasury bond investments at different maturities. The light blue line represents current rates. The dark blue line represents rates from the end of the prior quarter, and the gold line represents rates at the end of last year. Rates continued to increase at the short maturity segment of the curve, with ultra short term rates now exceeding 4%. Rates beyond 2 years were largely unchanged. While returns have been negative for fixed income this year with the dramatic increase in interest rates, the expected returns on fixed income are now much higher. For long-term fixed income investors, this is likely to be a net positive as the new money and maturing bonds are reinvested into higher yielding bonds. The yield curve remains inverted as it was at the end of last quarter. When this happens, particularly between the 2-year and 10-year points on the curve, it is widely regarded as one of the precursors, but not a guarantee, to an impending recession. Finally, we plot the market's forecast of inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations. The dark blue line represents inflation expectations from the prior quarter, and the gold line represents inflation expectations from 1 year ago. Consistent with what we've been hearing and reading in the media, the Federal Reserve's aggressive rate hike campaign has led markets to lower current estimates for future inflation compared to the end of last year. Inflation expectations were up slightly across the curve this quarter. As these expectations continue to change, it is important to remember that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of approximately 2.3% per year for the next 5 years, and the market collectively expects inflation to slightly outpace the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices, but they are also baked into equity prices. Making a bet on higher inflation would mean that we expect inflation to exceed the current forecast. Now let's take a look at how some major asset classes contributed to a 60-40 index mix this quarter and how that index mix behaved during recent history. On this slide, we'll look at the absolute impact of different asset class returns on the quarterly return of a sample 60% stock, 40% bond index mix. With both stock and bond markets increasing this quarter, we can see that all stock asset classes contributed to the overall increase of the index mix. U.S. large cap stocks were the largest contributors for the quarter. Diversifying stock holdings across regions, small and value stocks captured outperformance relative to traditional U.S. stock market exposure. This allowed the 60-40 index mix to achieve a return of 6.6% versus the U.S. total market return of 7.2%. The portfolio captured most of the upside from stocks while controlling risk. Here we see a collection of major asset class calendar year returns displayed on a quilt chart. Looking at 2022 returns in the rightmost column, we see that almost all asset classes posted negative performance, with real estate losing the most value at 26%. Cash was the only asset class with positive performance of 1.5%, as short-term treasury bills yielded greater interest over the course of the year. A diversified index mix, such as the 60% stock, 40% bond index mix shown in the white tile, tends to stay away from the extreme returns, both positive and negative, on a yearly basis and over time, while also dampening the volatility of returns. This is an example of the potential benefits of a well-diversified portfolio. It also helps us as investors to stay in our seats through any given quarter of market turbulence and not take away our ability to prosper from the many quarters to come. And with that, we've reached the conclusion of today's presentation. Thank you for joining us, and we'll see you next quarter.